I think the storm is just starting to pick up outside, so we'll see what happens, but I think we'll be fine. This week's guest is Carlos Hardenberg, who's the manager of Mobius Investment Trust, and should be an interesting chat, I think. I've got a few bits of news to cover before we do that. So just this week, we've seen some news on Honeycomb, which we initially thought was quite good, but we've had a sort of rethink. And we've got some new credit ratings for Civitas and Supermarket Income REIT, and I'll explain what that means. And I just thought I'd just have a quick mention of a couple of renewable energy funds, NextEnergy Solar and the Renewable Infrastructure Group, TRIG. So Honeycomb first. This is the share price chart for the past 5 years, with the NAV there in the greenish line, sort of fairly flat all the way across. And as you can see, it's not been great, really, in terms of the discount. The big discount opened up during the COVID panic. And although it's closed a bit, it's never closed completely, didn't go back to trading at premium again. And then you've got this tail off at the end here. And that's really in response to what's just been announced this week, but we'll discuss that in a second. Here it sits in its sector, which is the direct lending sector. So this is one of the funds that actually makes loans to individual borrowers without going through an entity necessarily, but sometimes it does. And actually, some of these things, they aggregate loans and do it that way. It's about 300 million market cap, so not too bad a size, but I think they would have liked it to be a bit bigger by this stage. And now on a 13 discount. It wasn't when this was all announced, it definitely widened out, but it was on a discount, as I said before. And as are most of the funds in this sector, so we only really got biopharma credit and GCB asset-backed income there sitting there on premiums. Returns-wise, though, it's been really quite solid. So although you've had a bit of a bounce back in SME credit realisation this past year, really the only other fund that competes with Honeycomb in terms of returns is the VPC specialty lending. And a lot of that came from the special purpose acquisition vehicle investments that it made. So it's kind of distorting the numbers. It didn't really come from its lending activities. So in terms of like lending money and actually getting a decent return out of it, Honeycomb's probably been one of the best funds in this sector to do that. The manager's been around since 2013. The fund was launched at the tail end of 2015, raising 100 million and then quite quickly raising another 50. And it's been expanding since then, as we've seen. It got invested really quite quickly, including putting some gearing on the fund. And so it's been steadily churning out a decent level of income and paying 80p dividends a year. So 8% yield on the IPO price, which is obviously very attractive. And the NAV, as I said before, has really been quite stable. So we're at an NAV now of just over 10 quid, and it was launched at 10 quid. So not too bad. And here's the numbers broken down month by month. I'm not going to get you to sort of look at them all, but if you just look at the annual numbers here, you can see how consistent it's been. It's really, really quite good. And up to the end of 2021, it returned about 50%. Which again, not too bad. This week, though, it's announced that it's going to combine with its manager. So effectively, it's kind of internalizing its management company, which does happen. It's happened a bit in the property sector. So we've seen a number of funds that were seen as investment company, property companies that have become sort of just straightforward REITs where they actually own a management company. So that's in itself is not particularly unusual. It's quite a big deal, so it's about sort of half and half in terms of the split of assets between Honeycomb shareholders and Pollen Street investors. And it will actually leave the sector, so it'll become a commercial company, and that's just an indication of a different set of risks and rewards going on here. It looks like a done deal, so they've got quite a concentrated share register, and a few of the really big investors have already said, yes, we don't think it's a good idea. And because we kind of like the company, because everybody seemed to be on side with it, that was our initial view, that probably this is a good idea and we should just let it go and wave goodbye and say it's a shame to lose such a good, consistent company. What Honeycomb is buying is down there. So revenue of about £34 million, EBITDA of about £7 million, and gross assets of 30 million. And what it's getting for issuing really quite a large number of shares. So also buying an asset manager with 3 billion of assets under management, on which it earns fees of about 1.25–1.5%, and there are also performance fees or carry. Actually, most of those end up with the staff. So Honeycomb is going to end up with 25% of those. And the attraction, as is set out in the document, is that they can use the capital within Honeycomb to seed new funds and grow those assets under management faster than they could have done otherwise. The downside, and really apologies for this because we didn't pick it up when we wrote the news story, is that the dividend's going to get cut. So from steady 80p that it has been paying, it's going to drop to 63p in 2022 and 64p in 2023, roughly. That's quite a big change, and the combination of that and the combination of generous risk and reward, we just think it's not great, really. So you've got a fund that was working very well. Yes, it was trading at a discount, but really there was no justification for that, and a bit of work on the marketing front should have been able to narrow that down, we thought, and then maybe expand the fund in time. The new strategy may work, but it is a much more risky proposition. And when you combine it with a dividend cut, if you're a Honeycomb shareholder, the thing that you invested in is not going to be the thing that you're holding once this deal is done. And I think for that reason, really, you should have been offered a chance for cash exit at NAV. And instead you've been sort of trapped into something, and people are just selling it because they're saying, well, I'm not going to get the dividend that I was expecting, so I don't want to be invested in it anymore, and that's what's driving the discount down. And I don't know how many shareholders are affected by this and how many feel that way, but definitely some do, and I'm really not sure that's all that great, really. In terms of regulation, which is a question that's been announced here, yeah, there are certainly different regulation things that apply to being an asset manager rather than being a fund, and that it was all part of the risk. So obviously, if as an asset manager you do something that contravenes the rules that govern asset managers, then you can get fined by the FCA and in trouble. So yes, that will change. So that's that one. Credit rating is a bit sort of boring, really, you might think, but it is quite a good kind of third-party deep dive into the structure of these companies that have been rated. They really do go into the nitty-gritty of what's driving them. And so when they come out and say, well, we think this has got an A rating or a BBB rating, it does actually kind of mean something. I mean, from a practical point of view, it should mean that for Supermarket Income REIT, who's just got its first rating this week, they should be able to borrow a little bit more cheaply than they are doing, but not much more, because they're already getting quite cheap debt, as you can see there. So they've got a cost of borrowing of 1.84% overall. But you also get the chance to raise a lot more money a lot more quickly from a much deeper pool of capital. That's one of the reasons why it's cheaper. So good news for Supermarket Income REIT, and just a sort of tick in the box for what it's doing. But the other one that came out this week is Civitas. So Fitch rated that last year, and then what they've done is they've just reaffirmed the credit rating. But in doing so, they've had a good look at what's been going on. But obviously, Civitas got attacked by a short seller and raised a lot of points that it said, you know, question marks over the quality of the income and things that it was doing. But I think these things that Fitch has highlighted here are actually quite important. And these are arguments that we've been making for a long time, which is that fundamentally, you've got tenants that are going to be needing accommodation for the rest of their lives in most cases, and it's not a good idea to move them around from place to place. There aren't that many places where they can be, and so Fitch has looked at Civitas. It looked at it in the context of things like Assura and Triple Point and other funds that invest in property that's backed by government income. And in each case, they do believe that whatever happens to the intermediate entity that is essentially Civitas's client, even if they fail, the government would have to keep paying the rent, because that you can't keep moving the tenants around, because they need the ongoing care and housing. And this is what's happened in the past with First Priority when that ran into trouble, and Civitas in the very early days, and more recently with Auckland. And they don't lose rent. There is a sort of disruption to kind of administration, but apart from that, there is really not much of an impact. So I do think that Civitas, which is trading on a crazy 20% discount with a 6.4% yield, is just cheap at this level. And you can see, again, the quality of that NAV. It just sort of keeps ticking up. Finally, NextEnergy and renewable infrastructure. Both of them announced some numbers this week. The NextEnergy one is just a quarterly statement. And you can see that the NAV is going up. And two things are affecting that. So inflation, because all the subsidies in the UK are linked to RPI, and RPI is now nudging up towards high end, sort of 7.8%, I think. And it'll depend where we are when the subsidies come around, which I think is April. But nevertheless, that's going to keep pushing up the income for these funds, and that pushes up the NAV because it affects the discount cash flow model. You've also got higher power prices, and that's helping too in the short term. And so, like many of the other funds in the sector, NextEnergy is trying to smooth the power price fluctuations by signing up 2-3 year deals with off-takers. So they're not immediately capturing the benefits of higher power prices, but as and when those contracts roll off, then they are, and that's added 0.6p to the NAV. And also just factoring the short-term power price forecast into the NAV is another little chunk. So it's not huge, but it's all going in the same direction. It's all going upwards, and that's true across the whole sector. If you look at TRIG, the 117 million on 2.5 billion is about 4.6%, and that is reflecting the income that it's been earning in the short term from much higher power prices, despite the fact that actually, I know we've got very windy day today, but actually the most recent period, so 2021, was quite a poor period for the wind blowing. And so production was a long way below budget, and nevertheless, it still managed to hold up and do okay. The other thing I noticed though about TRIG is that they also reduced the discount rate they used to value these things. Now, obviously doing that against the context of forecasting of higher interest rates, but those discount rates are driven in part by what price the assets change hands at in the secondary market, and they're saying that there's more and more interest in buying wind and solar projects, and that is driving down discount rates, and that is benefiting the NAV. We haven't seen, or I haven't noticed, other people doing that recently. It was a trend before a few years ago, but I haven't seen it recently. So it's interesting that they've done that. But if it's true, then it should feed into all sorts of other renewable energy funds as well. That's enough for me, I think. We will now